Let's take a look now at the capital structure, or capital stack, for an investment, whether it be the acquisition of an existing income-producing asset or a development transaction. Keeping in mind that the bar heights shown here are not to scale, we can see the constituent capital elements of a transaction, namely a senior loan, equity, and a mezzanine element, where the mezzanine capital closes the gap between the senior financing and the equity. The assumed proportions of these sources of funds are entered in column D, and the equivalent dollar values are calculated in column E. We note that the equity investors will often want to limit the entire equity investment to no more than 20% because it will be hard to make the equity IRRs they seek with much less than 80% debt financing, also referred to as leverage. We also note that senior lenders limit their loan amounts based partly on their estimation of what percentage of the market value of the property at the time of loan funding they could get if they had to foreclose on and quickly sell the asset that is securing the loan. This is the reason why most senior lenders will not go above 80% loan-to-value, because they find it unlikely that in a distressed quick sale situation they would be able to recoup more than 80% of the market value of the asset. We also note that the sources of funds must always equal the uses of funds, for the simple reason that the funds are raised to match the intended uses dollar for dollar. The order of funding is as follows. First is equity, second is the mezzanine loan, and third is the senior loan. The senior loan is the safest, most secure capital in the investment because it is collateralized by the real estate itself. The equity is the riskiest because it has the residual claim on cash flows, and the mezzanine is the second riskiest because it is secured by the equity in the transaction.